Marcos Mila, who is this finance YouTuber, had a super interesting interview, which I covered in one of my past videos, where he interviewed basically the manager of YieldMax, Jay Pestrichelli. So let's just call him Jay for the sake of me not butchering his last name every time. A very cool guy. So he asked him a bunch of questions about ULTY and Misty and some concerns about ULTY and basically like all the stuff that people are concerned about, like maintaining high yield and the risk and blah blah blah, all these things. And then we get to a point where he says like, okay, like he knows there's some people like flexing on social media that they have huge positions in Misty and they're making 6 figures, 4 figures, 5 figures a month with that ETF. But he says that at the end of the day, like if you go all in on Misty, you can't be crying when the market crashes or something goes bad with MSCR, because you are like exposing yourself to one single stock and the risk of one single holding. So he says, you know, maybe to have a more resilient portfolio or whatever, you could hedge with Winter, WNTR. But he says it's not a perfect hedge. Like if Misty goes up, WTR is not going to go down as much, or it might go down more actually. And if the market crashes, Winter might go up a lot, or might go up less than MSTY crashes. Essentially, he says it's a way to hedge, but it's not a perfect hedge, whatever. So then Marcos, I think he asked him like, how can you hedge against ULTY, since like you guys are already hedging by yourselves because you're doing collar options, which I explained in one of my other video about this interview. Is there another way to kind of use ULTY in a less quote-unquote risky way? Pair it with the S&P, pair it with growth, use the distributions to buy growth, whatever. So let's say what Jay has to say about hedging ULTY.
Yes. So so this is interesting, right? Because we have these volatile names, right, in ULTY, and we're still hedging them. So we end up having the volatility of about the Nasdaq, right? So we have the vol of the Nasdaq generally in ULTY, and returns similar. Like I'm looking, it looks like year to date, ULTY slightly outperforming the Qs. But what I would say is you can use the inverse of the Qs, YQQQ. There is a YieldMax they treat the Nasdaq as the underlying index, and we, sell put spreads just like we do with Winter. So if you,
all right, so if you guys didn't get this, he essentially said that if you compare the total returns and the volatility of ULTY, basically as of recently, or as of their whole history, ULTY seems to be following the Qs. So he says that YieldMax is offering YQQQ. Let me go find that right now. So there's this ETF from YieldMax, YQQQ, which is an inverse of the Nasdaq. And what he's saying is that ULTY is following the Nasdaq. So if you buy the inverse of the Nasdaq, it should be a way to hedge against ULTY. But as he mentioned in the interview, it's not a perfect hedge, but it is an option that you have if you're not as comfortable with the volatility of ULTY, or if you're planning on having a big position in ULTY and you don't want it to move your portfolio as much, that could be an option, right? So in this video, I want to cover that let's see for ourselves. Let's play with the numbers and see, can you really hedge ULTY? Is it a good idea? What kind of returns can you expect if you do hedge ULTY? And I mean, it's just for fun, guys, and maybe it's going to help some of us understand better and take decisions. So here's ULTY versus QQQ. As you can see, like Jay was saying, it's exactly the same thing. They're basically fighting neck to neck. They're side to side the whole time. If one goes up, the other goes up. One goes down, the other goes down. Sometimes ULTY is doing better. Sometimes the Q is doing better, but essentially same returns, right? All right. Now, YQQQ from YieldMax, which is the inverse income ETF of the Nasdaq. If you put the return of YQQ next to the returns of ULTY, as you can see, it's pretty much the inverse. It's not a perfect inverse. As you can see here, ULTY seem to be crashing much more than YQQQ is going up. And here ULTY seems to be going up faster than YQQQ is going down. So it is not a perfect hedge. So meaning that if you hold that in a portfolio as a 50-50%, so if you hold 50% of ULTY and 50% of YQQQ, you can't really expect your portfolio to stay flat. It might actually pull down or pull higher depending on which one is moving in which way. So let's play with the numbers, guys. So here, what did I do? I use my portfolio visualizer tool right there that I often use in my videos. I think it's a very cool tool. I created 3 portfolios. One portfolio has 100% of ULTY. The other one is ULTY and YQQQ hedge 50-50. So it has 50% of ULTY here and 50% of YQQQ. And then my third portfolio is 70% of ULTY and then 30% of YQQQ. So that means that it's kind of realistic in a way where you can have a big position of ULTY, and then let's say for every $10,000 you invest in ULTY, you would buy 30% of YQQQ just in case something bad happens, or if you want to reduce. Basically, you're going to reduce the volatility of your portfolio. But as we know, higher volatility equals higher returns. But at the same time, it also means that you're willing to take more risk, because if you want high returns, you can expect also that if something goes bad or if it goes down a bit more. But when it goes up more, right? Anyways. So what did I plug in here from August 2024? Because here it seems like YQQQ was the inception date was in August. So just for the sake of it, like I want that $10,000 to basically start when both of these ETFs are existing. And then reinvest dividends, obviously, because they're income ETFs. And every month I want it to rebalance. So if you have 50-50, basically every month we rebalance the whole portfolio to respect that 50-50%. And yeah, that's basically what I did. So now if I do analyze portfolio, so this is ULTY on its own, total return of 20.7% since August of 2024. That's almost a year. And then the standard deviation is 26%, which is pretty high, pretty risky. So here you can expect a downside of about 16-17% in exchange for some 30% upside. This is basically what it means. And the max drawdown here was 17.8. That's the drawdown that your portfolio would have seen at the all-time low. And then if you do 50-50, as you can see, the return is much lower. The implied volatility is much lower. And the maximum drawdown that your portfolio would have seen is much lower. So here you're basically, as I said, like having a 50% portfolio, these are not perfect hedges. So you're basically going to keep your portfolio flat. Maybe you're going to push it down, or maybe you're going to push it up a bit, but it's not really going to have a 0% return. It really depends on the conditions of the market. Sometimes you might be up, sometimes you might be down. But here you're essentially reducing your risk, but at the same time you have almost no returns. I mean, 4% is actually not bad, but you can have 4% with treasury bills. So, I mean, it's not really something that's interesting to take some like volatility, some volatile holdings to make as much as someone just holding treasury bills, right? All right, so now this one is a bit more interesting. ULTY and YQQQ at a 70-30% allocation. Here, as you can see, you still have some interesting total returns of 10%, 11%. Your standard deviation is 10% lower than holding ULTY on its own, which is a good way to de-risk and devolatize your, if that's even a word, reduce the volatility of your portfolio. And your drawdown is 10% instead of 18, 17. So you're going to see a 8% less drawdown on the worst case. So it's kind of cool. So here you have the summary of everything I just said. So you start with $10,000. If you only have ULTY, obviously ULTY is bullish. So like if you're hedging against something that is bullish, you're basically going to cap your gains when the market is doing well. But when the market is doing bad, you're going to protect your portfolio. So you're willing to sacrifice some growth, some performance to have a less volatile portfolio. So like, I mean, it really depends on your investor profile and what you want. If you're bullish in the long term and under your belt, you know, you have a lot of years in front of you, which I think most of you guys are watching this channel have. Like we're not going to retire in 5 years. We're not relying on our portfolios right now for full-time income and all these things. So I think for most of us, like, I mean, optimizing total returns is the best outcome possible. And then if you have a 50-50 here, as you can see, you're only up 4%. I mean, it's pretty ridiculous. Like you could have done the same thing with treasury bills or high yield saving account. And then here it's this one is a bit interesting. I think this one's pretty cool. So you're still up 10%. And when the market really crashed in April, you would have been down only 10% on your ULTY and YQQQ, which is still much better than the -7%. and at the same time so you basically kind of controlled your portfolio's volatility. Here you let yourself go down 10% in exchange to make 10%. So it's much more comfortable probably than going down 17% in exchange of 20%. So it really depends on your investor profile. And here, if you look at the graph here, we can see that ULTY, which is the dark blue, it's really aggressive and moving in a much more erratic and volatile way, and it crashes much harder. But then when the market recovers, it recovers much, much faster. And here, if you see the 50-50 one is the green one, it's basically kind of linear. Like it's not really moving. When the market is going up, it's going up slowly. And when the market crashed here in April, it barely went down. As you can see, the lowest amount you had in your portfolio was you were down $80 on the $10,000, where fully ULTY you would have been down $240. So it's a much more flat progression in your portfolio. So if you're someone who really wants ULTY and you're scared you think that your money's gonna go to zero, might be something you might be looking into doing, even though the returns wouldn't be the best. But here, if we see the 70-40, it's kind of the middle ground between 50-50 and all in on ULTY. So it's still growing pretty well. And then we had the big crash in April. We didn't see that big of a drop in the portfolio from the all-time high here before the crash. And then when the market started recovering, we still stayed above ULTY, but we still stayed under the 50-50. And then when market recovered, it didn't take a lot of time for the 70-30 portfolio to catch back up with the bull market. So I think it's very interesting to look at this because I just wanted to cover this in video because everyone's talking about ULTY, going all in on ULTY, but no one is talking about worst case scenarios and hedging. And I think it's cool to just know that this is an option that you have. Personally, I don't think that I would go with that because I am bullish and I want to take the most growth out of my portfolio. I would maybe be comfortable with a 20%, 10% hedge if I'm very scared. I think that if you're going to panic sell, it's better to know that instead of panic selling your ULTY in case of something bad happening, you can instead buy YQQQ with some disposable income and add that next to your ULTY. So then when the market is doing very bad, like in April, when the market was up and down, and it kept dropping and dropping, people might have panic sold. And the fact that you have the option to hedge ULTY now with YQQQ, which isn't a perfect hedge, it might help some people, like give you more doors instead of just holding and buying more and feeling like you're trying to buy a falling knife. Maybe buying YQQQ could be an option for people who just want to remove the volatility from their portfolio while things are bad, and then when things go good again, they can just sell all of their YQQQ and put everything back into ULTY. That could be an option. But I mean, timing the market isn't very good. Like, you're not trying to buy YQQQ when it's doing bad and then sell. Like, you don't know when things are going good and when things are going to go bad. All right, now let's I can't even talk. Let's look at a more realistic portfolio. So yes, $10,000 is okay. But realistically, most of us try to invest as much as possible every month. We try to grow our portfolio. So let's say you contribute $500 every month on top of that initial $10,000, and you contribution monthly, and you do rebalance every month. So if you throw in $500 a month on top of 10K, let's just go to the summary. First of all, let's look at the graph first. So here, as you can see now, they're much tighter, because whenever the market is down, you're adding some of your own money to your portfolio. So every time your portfolio is taking a hit, you're just throwing back $500 into it. So this is why it's important to keep buying and investing, even if the market is up, even if the market is down. Like, the best strategy is just timing the market. Always beats timing the market. So just like keep buying. Don't look at the headlines. And as you can see, it's paying off. So here, if you start with 10K and you buy $500 a month for a year, you would end up with $17,000 if you're all in on ULTY. If you're 50-50, you end up with you would be up 5K in total. This total return here is your ULTY return plus your cash flow, your $500 that you invested every month. And then the 70-30 portfolio, you would have had a total return of 64%. And what's cool about this is that, as you can see, you're kind of hedging your portfolio by yourself by kind of religiously investing. So here, instead of seeing a max drawdown of 17% excluding the cash flow, when you include the $500 that you're adding, because basically when ULTY is crashing a lot, you have the opportunity to buy the shares for very cheap. So here you reduce your drawdown to minus 10%. Here on the 50-50, you basically had no drawdown if you keep adding $500 a month. So this is pretty interesting. And then on the 70-30, you had a drawdown of only 1%. And in exchange, your portfolio grew 64%. So that's why I'm saying, like, you still have options if this is something some people might be more comfortable with. Like, it is possible to hedge ULTY. So yeah, I thought that was very interesting that Jay mentioned that. I never really thought about hedging ULTY and in general hedging the more risky positions I have. So hopefully you guys learned a bit more about this, and you know it's an option if it's something you would like to do. Let me know in the comments what you guys think. Like, do you think it's a smart idea to have a little allocation of your portfolio into some hedge? I know some people hedge the stock market with gold, for example, or with other assets. And ULTY on its own is hedging with the colors. On top of that, you can hedge ULTY. Yeah, all right. Let me know what you guys think in the comments, guys. Would you prefer just buying ULTY? Do you think hedging ULTY is something that would be viable or not? Something you've been thinking of doing in your portfolio, or maybe some of you are already doing it. So I'm curious to know that. All right, guys. So if you've been watching until now, thank you so much. Just wanted to let you know quickly that I opened an email. So whatever questions that you have or any video ideas, please feel free to shoot an email, whatever it is, and I would either answer you directly through emails, or I might start doing YouTube videos where I answer your questions through videos, because sometimes people have very good questions that could be valuable to a lot of other people, and you can learn a lot from other people's questions, and I can also learn from your questions. So I'll start making videos based on some emails that I receive. And I have my X here, IncomeGG. So if you guys want to follow me on X, feel free. I don't really tweet a lot, but I'm trying to tweet as much as I can whenever I have an idea for tweeting, but it's not something that I'm trying to force or whatever. So anyways, guys, until next time, take care.